Hello everyone. Hope everyone is doing well. Wish you and your loved ones a very happy 2021. At this juncture of the markets, we are at an interesting time. 2020 was quite an eventful year for the markets, and 2021 has started out on a very strong level. But I would say that one of the most important learnings from 2020 is that no matter how one might perceive the market to be, in the short term, the market is totally unpredictable, and it is only in the long term that there is some in terms of correlation with long-term growth and stock prices. So from 2020, as in the middle of 2020, when things were really bad, we all saw that the markets had declined by over 40%, and at that time nobody would have forecasted the market to be at 50,000 about 6 months down the line. So like the recommendation here is that look at investing from a longer term perspective, and look at it as an asset class which will grow and compound over the long term, and rather than focusing on the near term market timing where things can be very, very difficult to time in the markets. So with that, maybe just moving quickly to our fund, Motilal Oswal Business Opportunities Fund. So the fund for us is a multi-cap fund which is positioned across four key themes for us. One is the under-penetration in life insurance. The second is consolidation in lending businesses. And the third one is high-quality economic recovery, where we are primarily playing this through consumer discretionary names which are sector leaders in their respective spaces. And the fourth is around large cap and mid cap IT services and Fmcg business. So the portfolio as of today is about invested in 14 companies and 14 businesses which are of very good quality. And the orientation is to just in terms of have this 14 to 15 stock portfolio, keep monitoring that on a long-term basis, and let the money compound over a period of time. So just in terms of a little bit more on each of these key themes for us. So one is to begin with life insurance again. So we believe that within banking and financial services businesses, life insurance is a unique business wherein what you are typically having is primarily a view on long-term structural growth and under-penetration in the market. Just to give some numbers on this side, if you look at it, the total protection gap in India is about 83%, amounting to USD $15 trillion. So, which means that every say individual, for instance, if an individual earns 100 rupees annually, the family needs to have 2,000 rupees in the bank account if that person were to say die, to take care of the annual expenses. So at a 2,000 rupee lump sum and with a 5% rate of interest, you end up with 100 rupees of annual income, which is the targeted annual income. So at a country level, the $2.5 trillion GDP that we have today, the total protection requirement is about $20 trillion, of which only close to 15 to 17% is currently insured, and the rest 83% is yet to be insured. So this gives the long-term visibility on growth. Businesses which have the brand and the distribution over here are very well placed because of in terms of these two key entry barriers and modes. And because of this, the top 5 life insurance players in India, they command about 90% of market share. And we believe that with in terms of 25% return on equity, high growth opportunity and significant entry barriers, in terms of this will be one of the long-term structural stories to back from an overall compounding perspective. So that was our first key theme that we like and we own significantly in the portfolio. Move to the second theme for us, consolidation in the lending business. So one of the key numbers I like to quote here is the 5-bank concentration ratio in India is today at about 47%, versus 80% being the median for about 30 large economies globally. So at 47% versus 80% globally, we believe that there is strong room for market share gain by the top players. And within that, we believe that the private banks, which are run by able and competent management teams, are best placed to capture this growth opportunity in the medium to long term. And the focus for us is also on, in terms of businesses within the banking space, which have a very strong liability franchise, where you have CASA between 45 to 60%. And at the same time, in terms of also that you have because of that high CASA, that enables low cost of funds at about 4%. And in banking, your raw material is your cost of funds. And in terms of because you have a low cost of fund, that gives you the ability to lend to the best set of borrowers on either the corporate side or on the retail side at competitive rates of interest. So we believe that having a strong liability franchise is very important, and hence the banks that we own in the fund are very much along these lines of uh, the good brand equity, good CASA mix, and a very strong liability franchise, and a strong loan for long-term growth. So moving to a third theme of high quality economic recovery. So here, what we believe is that a linear growth in GDP typically results in non-linear growth opportunities in discretionary consumption. And by what we mean by this is perhaps that if, for instance, somebody is earning 100 rupees, 90% of that is spent on basic essentials and 10% is spent on buying discretionary products. But when the income moves from 100 rupees to 200 rupees, the 90 rupees spent on essential typically goes to about 100 rupees. But the discretionary spend, which is about 10 rupees, that goes from 10 rupees to 100 rupees. So that is a 10x jump in terms of the spends that one does on discretionary side. And as part of this theme, we believe that leading consumer discretionary names, which have the franchises like in automobiles or in premium two-wheelers, in terms of jewelry and so on and so forth. Many of the consumer categories which are beyond one's ability today in terms of purchasing power, as income profiles grow over the long term, these become in terms of like air conditioners, for instance. So just to give a number on ACs in India, we sell about 60 lakh ACs in India, and China sells close to 9 crore air conditioners annually. So a lot of these businesses will go through a J curve as and when the income profile hits that sweet spot. And the third theme for us, we are backing a lot of these businesses which have this potential. And over the long term, you will see that get translated into high growth and high shareholder return compounding. The fourth and the final one for us is large cap and mid cap IT and FMCG. So over here, our view is that if you look at the post-pandemic environment, Fortune 500 companies globally, a lot of those companies which basically saw spends on digitization, spends on public cloud adoption as more discretionary spends, which should happen 3 years down the line or 5 years down the line. For a lot of those companies, spends on digitization and cloud adoption have become here and now, and spends which are survival oriented. So if they don't spend now, basically they will lose out to the online competitors. And we believe that that is one of the key growth drivers for digital spends and cloud adoption spends. And Indian IT services companies also benefit from the fact that the large offshore potential that Indian businesses have had in terms of IT services. That also comes to the fore because today, even if an employee who is working on site, either he's working say in Boston or working offshore in Bangalore, despite being an on-site employee or an offshore employee and having in terms of billing rates 5 to 10 times that of the local employee, despite that, both of these employees are still working from home. So either you're in Boston or in Bangalore, you're still working from home. So with this, a lot of companies which were earlier reluctant to offshore, today they have realized that there is not too much of a difference between offshoring versus on-site. And the last 8 to 10 months time has given them the confidence that this particular offshoring model works very well. So from that perspective, Indian companies are well suited and well placed to capture higher spends on digitization and cloud adoption. And we believe that IT as a sector has entered strong growth in terms of growth period in the next 5 years time or so. And finally, in terms of FMCG, here we own some of the companies which are market leaders, which have a strong brand portfolio, product portfolio straddling across all price points, and which have the distribution being more with 7 to 8 million retail outlets. So that is the total exposure that we have at the fund level. To summarize, we have primarily in 4 key themes of life insurance, private banks, economic recovery, consumer discretionary names, and large cap and mid cap FMCG and IT companies. And it's a portfolio of about 14 companies, which is true to label PMS, and we're not looking to over diversify. At the same time, we believe we are adequately diversified at the fund level. So with that, let us draw this month's update from our side on the fund, and to a close, and we look forward to talking to you again in the coming months. So with that, thank you very much for the patient listening, and take care of yourself. Thank you so much.